Hello everyone, this is IWM Cafe. I'm your host, the Cowboy. Let's get started on the Macro Cafe. This was a series that I used to do, I think, last year for every couple of weeks. I'm trying to, reinitiate this one and take a look at the market, especially with the latest interesting developments that are going on in here. I think it's worth, diving into a lot of these details. So I have a lot of things on the menu and I want to get started right onto it. So let's go. All right, so once again, I'm your host, the Cowboy. This is IWM Cafe, and it is Saturday morning. Let's jump and take a look at some nice charts that I have prepared for you here. First of all, we're going to start with a little bit of a bigger macro picture and see where we are in the economic cycle. Then we're going to take a look at some of this data. And then we'll jump over to some of the large macro assets. We'll take a look at the SP500, Russell, gold, oil. We'll take a look at Bitcoin and, rates, stuff like that, stuff that's giving us hopefully some clues in kind of where this thing is going, because it's been a pretty messy 2022. So looking at the market cycle and the economic cycle in here, you can see in blue in here, you have basically the economic cycle that goes from a full recession, to an early recession, recovery, full recovery. And then you have, the larger, let's say, a market cycle through a market bottom, bull market, market top, and bear market. So whatever is in orange in here, you can see it's a market cycle. In blue, it's the economic. So they kind of overlap each other. And then back up here at the top, you can see the 11 sectors from the S&P 500 and kind of how they come in and out of favor based on where the economy is currently and what's going on. Do we have a recession? Do we have a recovery? What's happening? And then in here, basically, you have some of the stages that we're following, from consumer expectation to industrial production, interest rates, yield curve, and where they are, based on these cycles. So if you can see in here, and I prepared some charts, we're going to take a look next, but basically up at the top here, it shows you that the moment you're getting into an early recession, you're finishing up a full recovery and then you get into an early recession, things like healthcare, things like utilities, real estate, financials are more in favor. So more of a defensive sectors, consumer staples, energy, stuff like that. And then as you're going into more of a full recession, and the Federal Reserve starts to cut rates and, let's say, provide support to the markets along, both on the monetary side and the fiscal side with the government, then you're getting more into more riskier assets toward technology, discretionary communication services, industrial growth. Then you move into materials and the cycles, kind of repeat themselves. So if you can see in here what it says early recession, I have consumer expectations, which are falling sharply. That's a check. We have industrial production that's, falling to flat. That's a check. You have interest rates that are peaking, right? That is, almost a check right there. And then you have a yield curve, that is near flat with some inversion, depending on kind of where you're looking along the yield curve spectrum. So all these indicators in here are telling us that we might be into the early recession, or, possibly, even into a full recession. Although, there are indicators that are not shooting all the way there, but we could be beginning to enter into something more serious in here. So here is some of the indicators that we're watching based on that. So in here you can see that you have this is the consumer sentiment, and it's the lowest I think it's been since its inception. We are below 50, and it's just you can see in the political poll numbers of the president of the party. You can see in the inflation data. So people have a very kind of bad and scary kind of outlook for their future, based on their expectation, on their economic expectation, and kind of how they feel, about their life, about their money, about, what's going on in general. And so consumer expectations are very, very low. I mean, you're looking back at 2008 crisis. No, you're looking back in 76, in the 80s, nothing like that. Back in here, you have the industrial production, which is also kind of falling sharply, and it's stagnating a little bit. And if you look at the producer, if you look at manufacturing index, that's also kind of coming down. So, we're not doing really, really well when it comes to production and manufacturing. And back here on the lower left corner, you can see the yields, which have been rising aggressively since the beginning of the pandemic. And now we've gotten quite elevated into these yields across the curve, from the, let's say, from the 1 year to 2 year all the way to the 30s, yields have been rising aggressively. And, we could be starting to peak in here by the way this kind of looks, even from a Elliott wave structure. It seems like this was a larger third wave, a fourth, and probably in some kind of a fifth. The Federal Reserve seems to have already kind of lost this narrative, and they're chasing basically these yields in here, and they're trying to kind of temper inflation and just throw everything they have at it to try to destroy demand and get us out of this high inflation up into the 8.5%, although I'm sure those numbers are low. We're probably up in the double digits somewhere. So these are possibly towards a peak, because I don't think the United States economy can sustain very high levels of interest rates, and Fed might be forced to pivot here. Maybe not this year, but maybe early next year. Who knows how much more they'll be able to continue to push raising interest rates before things really get damaged. So, and then back in here you have the yield curve. So this is the 10-2s, which got inverted really quickly in April, and we went back, and now we're coming back to kind of retest those lows. So you have almost an inversion in the yield curve. This happens, let's say, between the 10s and the 2s, but not on the lower end of the curve between the 3s and the 2s. So that's still looking pretty decent. So there are some mixed signals in here, but a lot of these indicators here are starting to tell us that the economy might enter into a recession. So you can kind of hear talks about this, and that's why I wanted to kind of present to you what's going on in here. And as soon as we're kind of getting more towards a full recession, markets are forward looking, and you'll see that we're probably forming a bottom in stocks, and as the Fed starts to cut rates, then you're probably looking to start kind of moving towards the risk spectrum of the market, right? Technology, discretionary, cryptos, stuff like that. But we could still be a little bit early before that turns around. All right, on the next one here, I have basically, because I want to talk a little bit about the dollar. I haven't touched on the dollar in a while. And this is basically an overlap of the 10-year yield. So that's the TNX on stock charts. And then that's you can see in here, right? 32.39. Basically, you take the one decimal, so you look 3.23. It's the yield on the 10-year, and then you have the US dollar index that pushed higher above 105. What's interesting in here, and I'll show you on the next chart, we start to have divergence, with the new high in the dollar index and the RSI, and, usually that happens on a 5th to 8th type advance, and you're losing that momentum to the upside. So I think the dollar, it's starting to signal in here that it's getting exhausted. It's starting to signal that the Fed maybe has gone up too quick, too fast, and they might have to slow down a little bit in here. The yields are also making new highs. There is also a divergence in there. So you can see how the 10-year the dollar kind of follows this increase in the rate. So here is what's going on. I mean, this is looking back. It's just looking back about 3 years, 3-4 years on the dollar index. We've broken up to some, decent highs in here, but nothing yet. If you look back at the 50-year chart, which I don't have on here, it's not a clean break. We're basically pushed above 100, came back. We had a little bit of a sell-off to 102, then, went back one more time. Look at the RSI, how the dollar is kind of losing momentum. So there might be a fourth wave forming in here. Maybe, this is just a fifth wave when we could start to correct lower. But keep an eye on the dollar, because the moment this thing starts to weaken, could give a pretty good signal for the risk assets overall. So far, it's still strong, but it's starting to look like that momentum is waning, and things can start to push back. And one of the greatest signals will probably come from the inflation data. If that starts to pull back, then you'll see a big crush. And already oil starting to push back. Some of the agricultural stuff, so some of these commodities are starting to kind of pull back, and that could be a signal that the inflation is about to abate. So let's see what I have next. This is another indicator that's widely watched. So by by the macro guys, but hedge funds, everybody that kind of provides research for clients, stuff like that, is the copper gold ratio. This is a monthly view. And you can see in here periods where the copper gold ratio was moving down. So copper is a very good proxy for risk. When people, are excited about the economy, about the future, this will show up in the copper price is moving higher, right? That means copper is a big industrial metal and it's widely used. So this is, a very good gauge of what's happening in terms of growth globally. So when that line pushes higher, right? And this is, if the line pushes higher, that means people prefer copper versus gold. When this line moves lower, they prefer gold versus copper. So they fly into safety or they go up into risk. So you buy copper, you go higher, this ratio moves. You buy gold, you're trying to kind of stack it underneath your bed or put it in the vault or whatever for shitty times. And, this ratio moves lower. Now you can see in here, since the beginning of 2021, as the markets were struggling to kind of climb up higher, a lot of the strength in the market underneath the surface on the breadth side, started to kind of crack, and a lot of stocks have moved below their 20, below their 50, below their 200-day moving average. Some of the large cap stocks were holding the stock market higher, but there was deterioration happening underneath the surface, along with the copper gold ratio starting to push to the downside. And you could see that, copper and Bitcoin are also widely correlated. That's why I keep showing that ratio. And, as Bitcoin kind of tried to break up higher, this was not really confirming it, and then we started to break lower. So we're still in this kind of yellow phase, which means weak. You can see you have a big section between 2018 and 2020 where the markets were climbing but at a lower rate, and they were kind of struggling creating that big flat formation. There was another period here between 2014 and almost middle of 2016, where the markets did not do a whole lot. This ratio came down. Obviously you had your 2008 crash in here. It was the big one. Then you had another sell-off in the market, 2011, 2012. Copper gold ratio came down. So something to definitely watch in here and see how much longer this will last. If this is just a little bit of a pullback and we're going to continue to climb higher, maybe reach highs that were, from back 2004, 2005, depending on, what's going to happen with the, with the Fed and how much more aggressive they want to remain. But for right now, this is in a downtrend. So the next one that I have in here, we're going to take a look at some counts, because I think it's important to see where we are in the larger cycle. And I have two charts for you. Actually, I think only on the RUT, not on the SP500. Anyway, this one, it's the cash index, so it's the SPX. I don't have the futures on here, but on the bullish note, we're looking for this. Let's say if we're continuing to grow in a much larger, let's say, economic cycle, and even though we're going to a little bit of a correction in here, but let's say longer term, we're still in a secular advance, counting this as a 1-2 makes total sense. There is a count that I have that this is counted as a fourth, right? So this is an A, B down in C for the fourth. This was a fifth, and you're beginning a much larger sequence, and you're crashing, and you're, let's say, going into, who knows, some kind of a depressionary type period, possibly, right? If you're just entering into a recession, recessions can turn into depressions. God forbid something of the 30s. Right now we have, I think, a different system. There's a lot more, kind of modern monetary theory and stuff like that probably going to start to kick in, and these guys won't let that happen. But, you never know, but that would call, let's say, for a much larger decline into stocks. So staying on a positive note, that would be a 1-2. And the signs from the highs to the lows here, they don't really show, a big impulsive move at the moment. They just show some type of a corrective pattern. So we're still inside this channel. We're above the, middle line of this channel in here, coming back to retest it. And I'm looking at this possibly as a 1-2, because I don't think a fourth wave fits this anymore, based on this advance, right? You have the larger decline that was back in here, this correction. This is much, much larger, and it has to be considered as a different sequence. So possibly, a second wave of a wave one, of a much larger, let's say, third wave cycle in here. So you're familiar with this because I've talked about these counts in the daily videos that I do for the YouTube every once in a while there. And, the pullback, it is a 1. So that's the top of the wave 1. The pullback is an ABC for a W up in X near the B wave, and then another ABC in it. So I'm looking at it as a double zigzag for right now. Now, I'm not sure if, the C wave lower found, or maybe there is another push lower. But again, we're getting into some extreme bearishness, extreme sentiment in here as we're dropping. People are selling everything, and it is, it is a pretty down mood across, and, on Wall Street. So, it could be here that we're approaching an end to the C wave. This is kind of what I'm going to be watching. If this move starts to move lower much stronger, and you're getting towards 3,400, 3,200, 3,000 in here, that becomes a larger third wave. And then we have to change the approach to a 1, 2, 1, 2, 3, 4, 5, 4, and 5, and you're going to continue to crash lower. The problem that I have with that is this kind of decline in here, because it doesn't really fit the narrative of a 1, 2, 1, 2. So those are, extremely, unlikely counts. And usually wave 1 at a lower degree, it's a little bit smaller than wave 1 at a higher degree. So these are just kind of signals that are telling me that that's not likely to count. So that's why I look at it as highly corrective still, although through a very sharp zigzag, right? Just a W, X, and then up in Y, down in Y. We'll see what's going on in terms of recovery. Here is the Russell. This is the Russell 2000. This is, again, another kind of widely watched, small caps, mid caps, stuff like that in here. And again, just looking from the COVID lows in here, back towards the end of 2021, when we have found a top. That was a 5-wave move in a 1, 2, 3 triangle in 4 up and 5, completely reversed lower in this, again, this WXY formation. Now you can see here, Y versus W, it's got equality at about 100%. It starts to look very interesting. You broke below the channel in here, so that's a little bit of a negative, but you're up into the 38%. Wave 2s can, more often than not travel all the way to 61.8. I'm not sure how the structure would look if we're getting a drop to 1380 in the Russell, but that's, a high probability that, we could be hitting that. The thing is that this sequence here looks to be, pretty interesting and pretty near completion. So we don't have to go all the way back there. Let's see how this looks. So this is, again, it's just an A, B, an up and C, or you can do this a flat, right? You can do an A, you can take this, maybe I put it wrong. You can do an A, B, C for B, so that's your A, B down in C for a W. You connect here to an A wave X, and then you have the next decline, again, 1, 2, 3, 4, 5 for an A, up in B, and then another sharp in C. We're discussing this sell-off in here, pretty sharp. Again, this could become a much larger third. I don't think so, based on the way the sentiment looks. So shorter term, I think we're going to get some kind of a recovery here, maybe into next week or the next couple of weeks. And then we'll see if this is just corrective and it's, let's say, another 1, 2 for some reason, and then you crash lower. That's going to be problematic for the count, because it's going to push us much lower, and this could be a much larger top. So for this market to kind of survive and start to move back to the upside, we'd start to have to start to push higher, take over this B wave, take over this X wave, and kind of consider this correction complete. So still in a big downtrend, but towards the bottom of this channel, usually you're getting reactions from here. And we'll watch and see what happens. Okay, just a quick look on gold, because gold, it's a very interesting market. It hasn't done a whole lot. It doesn't lose value, so it's just kind of holding in there, which is, sometimes, again, when you want safety, you're maybe moving to gold, and at least you're preserving value rather than necessarily losing it, as some of the other asset classes have been doing in here, from bonds to stocks to crypto, stuff like that. So, once again here, gold proves to be maybe a decent, safety, to have it in your portfolio as a balance against some of the other risk that you're taking. So anyway, from a longer term structure, looking at this as a 1, 2, and then beginning of another 1, 2 in here, and a much, as the US dollar loses value, as the fiat currencies kind of, what happens with them, gold can continue to kind of benefit. But it's, it doesn't necessarily have to move straight up. We've had a pretty good move from 2000 to 2010, right? So that was about a 10-year, rise in the price of gold. Then we pull back in the second, maybe a flat in a 1, 2, up in 3. Still possible formation here. I don't know if we're going to get another flat in here, because, you've got it already. If you've gotten a flat in here, maybe there's still a triangle going on in an A, B, C, D, and E, still for a fourth wave, then a push higher and fifth of 1. So that's kind of my main count that I'm looking at, and see kind of how this will unfold, and it makes sense that it could be something that could be working in here. I do think that this was just a failed rally up in there, particularly for a B wave. I mean, it's got that kind of personality. So now we're waiting to see if we're going to get a C wave, either all the way back to the A wave low, or maybe lower for a little bit and then push higher in a fifth wave. But gold, it's in a nowhere's land, and it's kind of just telling me to just stay put and just kind of watch it. But that's kind of what I want to see. Maybe an end to the C wave to kind of, and then a reaction higher to start to get me excited about a possible push to the upside. This from here could be, I mean, you could move this fourth wave where this B wave is and just consider that a triangle, and then there would be a wave 1, a wave 2, and now you're probably beginning to move higher. But until you're actually going back above 2000, I don't think it's a high chance of success. And here is how this can look on this is the risk. This is the much larger decline in gold, where basically this was a B wave rally, just like kind of what's going on in Bitcoin right now, right? You've had that B wave up into the or a fifth wave, right, up into the 69 to 70K, and now you're crashing lower. So gold might have a similar fate, where this is a 1, especially inflation comes down, commodities complex come down, gold can actually crash. So the move back here from the 60s, 40s, you go up in a wave 1, down in 2, and this took, what was this, 20 years of gold not doing much. It's kind of sideways. Then the big advance from 2000s to 2008 in here. So you're going 2010, 2000, even more than that, right? So third wave, possibly, and now you're doing a fourth wave in here that would have to kind of mimic the second wave. So it could be a period of another, who knows, 10 years of gold not doing a whole lot, just kind of correcting and just kind of moving sideways. Maybe a downtrend, if inflation comes back down. So I wouldn't be surprised if gold comes back towards 1100, and just does an A, B, down in C, finishes a 4, and then in the next kind of crisis, whatever, it's pushing higher in a fifth. So keep this in mind. I'm looking at this, especially because I'm seeing, a double test of those highs with a failure up there. That could be an interesting one. So that's gold. Now let me touch quickly on oil, because I've been beating the drums here for the past month or so about how this is a possible B wave rally. We've shorted, I'll show you some of my trades. We've shorted oil, we've shorted XLE, Oxy, a bunch of these companies that have enjoyed this profits regarding, when it comes to the price of oil being so high. And I think that this market, it's been, too excited, right? Every time this trade got overcrowded, right? A lot of people just started to pile into energy. Is the short trade, is the thing that goes up, is the thing that's going to save us, is the thing where I'm going to keep my wealth, or whatever, right? And when the boat tilts too much on one side, it tips over. So again, just another B wave, just like you had in gold, just like you had maybe in Bitcoin. This is possibly a top in here in oil, followed by a pullback in this, for now, in the C wave. This fourth wave could be done as a triangle right there where I have my dot. So as a fourth wave triangle and a push higher and an ending diagonal. And this structure here, right, at the higher degree of trend, that wave 5 could be already done up in there. Okay, and you can actually start to begin the decline in this B wave, right? Because, you never really know for sure. Things just kind of hit a top, and then they start to correct, and then they start to get impulsive, and then they crash. So, with this trade being so overcrowded, I have a hard time staying super bullish oil and energy up into these levels based on the structure, because you go in a 1, 2, let's say a big 3, 4, then 1, 2, 3, 4, and 5 in here. It could be that maybe there is a fourth wave here at this degree of trend that's still forming, and one more push up higher. That's totally possible. But, shorter term here over the next few months, I think oil trade is kind of cooked, and it's probably gonna hit back towards 100, if maybe even below that. So watch this A wave low, see kind of how we're selling off out of here. But that's kind of where I'm at on the oil, and I'll show you a couple of trades that we have taken in there. So energy, just kind of watch out. All right, really quickly touch on Bitcoin. So this is the white count. I've done a video, I think, a couple of weeks ago on Bitcoin and Ethereum. Bitcoin has been coming down. It broke $20,000 this morning. And here we are at about, trying to break 19 to the downside. This remains as my favorite count, as a white count in here. I shifted this wave one over to the right. And this was one of my concerns as this market was making new highs in here. And it was starting to sell off and breaking below these levels. Because, the size of this decline, it starts to be problematic as a wave C or even as a, let's say, wave Y from a WXY perspective. So I think I feel more comfortable pushing a wave one in there and considering this a wave two decline. The size of it, the feel of it, the whole thing here, it just smells like, this was, a top of a wave one and not just a B wave from an ongoing structure. I could be wrong, but that's kind of how I'm looking at it right now. And then we'll see what happens with the second wave. We're coming back towards this massive trend line that started back here, touched the COVID lows. We're right there right now. There is again a big confluence. There's some, fib levels in there, and it's, there's the previous highs. We have the 200-week moving average as well. So things here are looking, as bad as they can possibly for Bitcoin right now. There's a lot of articles, there's a lot of companies going belly up, and there's a lot of fear and capitulations in this crypto market, and that usually happens when you're getting the C wave kind of type down movements in here, right, into the final stages of a decline, and looking at the second wave as being, again, it's just a W, X, and then another A, B, C here for a wave Y. So just a double zigzag like you have in the stock market. All right, it's a very, very kind of a similar story. And then if you don't like how I'm placing the second wave, I give you an alternate back in here. You can do a 1, 2, then another 1, 2 in here, 3, smaller 4, up in 5 for the wave 1, then you pull them back in the second wave. So 50% comes in at about 14,631, and then 61.8 for the second wave comes in at about 10,240. So, if this market, if this is a second wave of some kind, right, and he wants to pull all the way back there, allowing it, that's a possibility. But again, we're up here in this trend line, and if this doesn't happen, and we're not holding current levels, slightly below this, it's fine. But if we're not starting to hold and start to get bids and start to move higher, there's a big risk that this is what's going to happen in Bitcoin. This is my yellow count. I've been with this one for a while. I kept pushing it to the side because it just, the market was obviously very bullish. We're all, kind of falling into the same, the same narrative, right, of this crypto assets being something new and excited and growing and stuff like that. And it's very easy to kind of get caught up into the excitement and the price movement and forget that, this wave one cycle could have already happened up in here, from a wave 1 and 2, large 3, 4 into the 38%, 1, 2, 3, 4, 5, and you're done. Now, if this decline starts, it starts like this in a wave A. So you need to have 5 waves. So far we don't. We have a big correction right there. So that would be, let's say, wave 1 of a decline, wave 2, 1, 2, 3, 4, and 5. So 4 and 5. So you would still need to come lower, maybe back towards, who knows, 14,000, 13,000, something like that in Bitcoin, right? But when you're starting to push lower, right, towards these highs, back there like that, that would terminate the wave A only. So this becomes impulsive, right? That means that there is a lot more to correct. Sure, you'll hear people saying, well, this could be an A, B, and then a big flush in C. I doubt that very much because it doesn't have the personality of that C wave. That's a little bit sharper when you have flats in C wave, right? This one was kind of organized, the sell-off, and then now we're just kind of picking up steam. So it looks to me like if that's the case, this is basically a third wave of an ongoing A wave decline. So that's A wave, then up in B here, right, which could be a pretty big, massive rally. Let's say you're going from 15,000 on Bitcoin back to maybe 45K, but just for a B wave, depending on kind of how this unfolds, and then pull back again and just correct this entire, massive advance in Bitcoin. And, that will be the test of survival for it. But this is the yellow count on the more bearish note. So we're going to keep an eye on this one, right? I'm pretty optimistic about this just based on kind of where we are in terms of sentiment, but we need to see a recovery. The next slide that I have, it's some of the, some of the trades that I have taken in here, which I wanted to show you. So buying XLE puts, this was, I think, around June 13 or June 12 or something like that. So we closed this, nice gains in there. We just got put straight. And in a few days, the market paid us. I should have held on to them a little bit longer. I mean, I'm probably, probably could have doubled that at least in there, but still a pretty good, decent trade up in there. We did some shorts in natural gas as well because that looked pretty frothy, so we took some gains on there. So I have this, this on the Total Access Pro, you have access to this service, right? Is this separate channel which is called Elliott Wave Cafe Pro Live Trades, where I just tell my members, my clients, there everything that I do, this kind of that I trade, what I find stuff, and I just put my trades all the way up there for people to follow if they want to. So then we got short via futures. You can do this obviously via future, via USO, whatever. But that was some of the entries. We bought some SoFi calls in here. We'll see if so far I'm negative on those, but so we're doing some stocks as well, and some puts and some calls and stocks. So that's a trade that I'm kind of running right now. Then I open a position on when was this? Was it on Friday or Thursday? When was June 16th? Today's Saturday. I think it was Thursday, right? 1664, doing fairly okay based on the count that I have in there. I think I wanted to take the long side, and then again, just some short contracts, and we closed this one. We took it at about 119 and we closed it at about 109. So, a nice almost 9% gain on the oil shorts in there as well. So, come and visit me here and see what we trade. Here is what I offer and the services and the prices if you're interested. And you can find this at me here, Elliott Cafe _bot, and I have one T only, so that's a little trick. Just the one T in Elliott Cafe. But yep. Thank you guys for watching, and I'll see you next week through probably some more videos, and we'll try to pick up this kind of macro review, maybe every 2 weeks, maybe every month. We'll see, how much information we're getting and how the markets are moving in here. But again, thank you for watching, and I'll be talking to you later. Bye-bye.